those of you who I have not yet met, my name is David Sung, and I'd like to welcome everyone to our 2014 Market Outlook. Now, before I turn the podium over to our speakers this evening, I'd like to take a few moments and perhaps remind ourselves of something that's important when it comes to investing. The investor's chief problem, and even his worst enemy, is likely to be himself. The investor's chief problem, and even his worst enemy, is likely to be himself. Benjamin Graham is the author of this statement, and he's considered to be, by many, the father of value investing. And Benjamin Graham was the teacher and mentor to arguably one of the world's most successful and certainly wealthiest investors, and that's Warren Buffett. And Warren Buffett once commented that Benjamin Graham's book, The Intelligent Investor, is the single best book ever written on investing. So what did Ben Graham mean by this statement? Let's take a look at the following example. What you're looking at here is the Nicola Wealth Management Global Equity Fund, and many of you here who are clients are investors in this fund. And what we'll look at is the performance results of this fund over the period 2011, 2012, and 2013. So here we go. In 2011, this fund lost 11%. So imagine if you had 50% or more of your portfolio invested in something, and in 1 year it lost 11%, and you got to the end of the year, how would you feel? Right? Left to your own devices, what would you have done? Would you have sold? Now, behavioral investment theory suggests that when faced with volatility, that's precisely what most people would have done. They would have sold. Now, of course, in the case of our global equity fund, that would have been a poor choice. In 2012, the fund returned 17%, and last year, 2013, the fund returned 30%. All right, that's great. So now that the fund has done exceptionally well and it's back up in value, what are you going to do? Should we back up the truck and pile more money into the fund? Well, behavioral finance and behavioral investing shows that as investors, we're all pretty good with hindsight, and we're good with making decisions on an after-the-fact basis. Now, Dalbar is a Boston-based consulting firm, and each year they come out with a report that's called, they weren't that creative here, it's called the Dalbar Report. And the Dalbar Report shows over a period of 10 years how the average mutual fund has performed, and how investors in those very same funds themselves have performed. And as you can see, we call that the behavior gap. Now, we featured the Dalbar study a number of times in our NWM newsletters, and on each of your chairs this evening is our most recent newsletter featuring the Dalbar report. It might be a good read at home later tonight if you're having problems falling asleep. All right, so what does the Dalbar report actually look at in terms of numbers? Let's look at some examples. What you're looking at on the left-hand side of the screen is the average balanced Canadian mutual fund return over the past 10 years. It's been a dismal 4.5%, and not a great result in our opinion. And what you're looking at on the right-hand side of the screen is the average Dalbar investors' returns investing in those very same type of investments, about half that number, or 2.4%. So these investors are barely meeting inflation. Now, the underperformance of the average investor, of course, is due to their tendency to sell after things have gone down in value and only buy back in once they've appreciated back in value. As Benjamin Graham put it, as investors, we truly are our own worst enemy. Now, as many of our long-term clients know, we help our clients mitigate not only the risk of the markets, but the risk that we as investors pose to ourselves. Our investment philosophy that we've discussed many times over the years with our clients is one that's very similar to some of the world's largest and most successful institutional pensions. A good example of this, which we've shared on occasion, is the Canada Pension Plan. Now, much like the CPP, our approach to investing is a very diversified approach, and we use asset classes that are not typically found in a retail approach to investing. Those asset classes include things such as private equity, infrastructure assets, and commercial-grade hard asset real estate, in addition to other income-producing assets. Now, by building portfolios and exposing ourselves and our clients to less than 1/3 of the volatility that you typically find in a retail balanced approach, we counsel our clients to make decisions based on reason and not on emotion. So, while the past year has generated healthy returns for investors, most of us want to know what will follow and how we are positioned to withstand a potential downturn in the markets or continued volatility as we've seen over the past few years. So with that, let me introduce our speakers tonight. Rob Adel, our Chief Investment Officer, will begin. And Rob will talk about 2013 in review, what occurred, what happened. He'll talk about current economic conditions. And lastly, Rob will go into a little bit more detail on our firm's investment strategy. Following Rob, our CEO, John Nicola, John will talk about the impact that rising interest rates can have. Unfortunately, we might be in for potential higher taxes for high net worth investors. And lastly, what could a future look like in an era of continued low investment returns? Now, following John, as usual, we'll open the floor up to a question and answer period. And so with that, please join me in welcoming our Chief Investment Officer, Rob Adel.
David, that's the clicker.
There you go.